Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. It is Thursday, the 1st of September, 2020. Yeah, still 22. This is one of the toughest months for the market, according to history, as I'm sure you're all well aware. It's kind of fun coming at you a little over an hour into the trading day. Had a busy morning, so just getting around to the podcast now. But taking a look at the screen, it looks pretty ugly out there. 3,900 is supposed to be this line in the sand that folks are pointing to for support. As I'm looking right now, 3,904. We may bounce off there today, entirely possible, and my technical work shows that we are a little overdue for a bounce in the market. That being said, I think that the short and medium term lower prices await. I don't know if you saw Jeremy Grantham's very cheerful update. He's always a cheerful fellow. That he wrote. You can pull him up. Jeremy Grantham. I think it's GMO. You can find him online. His letters are public. But he's talking about the worst is yet to come with the popping of this super bubble, as he calls it. And then you've got other research out there showing that the last 1/3 of a bear market, in terms of the duration of the bear market, is the worst in terms of declines in performance. So the idea of breaking the June lows should be front and center in your mind. I think that is a firm possibility, given you look at what's happening out there to some stocks, previous technology darlings or what have you, whether it's a CrowdStrike or a MongoDB. They've put up good numbers and are just getting absolutely destroyed. I mean, their guidance might have been not quite what people were looking for, but Mongo talked about really seeing their product offset Oracle for a lot of their customers, which is interesting. But it does not matter. It's kind of like I talked about yesterday with CrowdStrike. We owned some, and I told you I was going to see how it acted, and it acted terrible, and it continues to act terrible, and I think it's going to continue to act terrible. It's just too expensive. The market does not have a firm, I think, grasp on where interest rates could top out. Even though inflation, I think we all say inflation's peaked, and you look at like the Baltic Dry Index, you look at a bunch of metrics, and prices seem to be falling pretty hard, pretty fast. I think, unfortunately, we are now at the earnings phase of the bear market, so we've done the interest rate part for the most part. Maybe we're mostly through that, but now you got to think about the earnings phase of the bear market and what that looks like. So you take companies like an NVIDIA, that was just a total darling out there, and look at the numbers that they've got for estimates out there. Excuse me, let's just pull them up right now. Take 2 seconds. So earnings, we are looking for the stock trades at a forward price to earnings of 29 times forward. NVIDIA still even down 9% today at 130, under 137. So that's probably wrong. So the earnings estimate for next year is probably too high still. So you got to think about that. So that 29 is probably more like 35, 38, who knows? But you got to think about that E being wrong, and that's not just NVIDIA, but really anything cyclical at this point. I think you got to think about that E being too high. And like I said yesterday, I think you want to be within 10% of that trough valuation before you start scaling into these things. So we're not there yet. So that's for the cyclical stuff. I think that's what you got to keep in mind. And you also keep in mind the possibility of an overshoot. So back to what Grantham says, his gloom and doom. Guys like that, I think that scenario is possible in an overshoot where you just get complete panic, and you get people just running for the hills because most retail, the data that I've seen, most retail has not sold yet. So that could be something that still is on the come. Another thing to keep in mind, not that cheery, but that's just the reality of it right now. Looking at commodities are all pretty heavy. I think the idea, I had a pretty, what I thought was a good thesis about commodity producers like, well, aluminum, steel, what have you, doing better based out of the U.S. versus international because of our cheaper cost of gas and what have you. That all might be true, but I think the macro thought of just declining consumption is really starting to take over. So whatever kind of nuance was there from that is not mattering yet. I've exited a few of those. No more Freeport, no more Alcoa. I will potentially revisit here in the near future when things cool off a bit, but as of right now, I'm just going to step out of the way. In terms of volatility, we started to put that on. We are going to put more of it on as things go ahead. We should, again, I think we're oversold. We should get a little bit of a bump up here, but sentiment is just so terrible. And I think that maybe some folks really thought that the bear market rally was start of a new bull market. Who knows? But all right, that's it. I don't want to ramble, but I think be careful out there. Do not be afraid to add long volatility of some sort into what you do. If all these kind of big bearish prognosticators turn out to be even somewhat right, vol's going to explode, which it has not done. So that could save your bacon. Okay, that is all. Have an awesome Thursday. We will talk to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The Ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, Grinnellcapital.com.